Unless you're sitting on an oil field or a really big inheritance, you're probably going to need to finance your next home purchase. And that raises questions, at least one big one that we're going to tackle today. Should you wait for the rate? I'm Greg Somerville, a realtor here in Richmond, Virginia. I'm not an economist or a financial planner, so please don't make any life or death decisions based on what you hear in today's video.
No.
But at the risk of going above my pay grade, we've got to talk economics. Making good real estate decisions involves understanding some important financial realities. And as you'll see, they aren't always what you would expect. We're going to whip through 9 important questions. If you'd like to follow up on any of these details, or if you just appreciate some inside information on the Richmond real estate market, my cell number's on the screen. Feel free to text or call at any time. And while you're at it, click the link in the description below for a free copy of my Richmond home buying guide. Well, let's dive into real estate economics with question number 1. As you look at the following chart, you'll see that today's 30-year fixed mortgage rate is almost where it was 50 years ago. After steadily decreasing for 40 years, rates recently took a sharp turn up. In 1975, the average rate was 9%. In 1981, the rates peaked at 18% due to double-digit inflation and an aggressive response by the Fed. The rates came down dramatically over the next decade. In 1990, they were 10%. In 2000, 7.5%. In 2010, they had dropped to 5%. In January 2020, the average rate was 3.7%. And then came COVID. In response to all the fear and uncertainty, the Fed slashed its rate. By January 2021, the rate was at 2.65%. A year later, January 22, it was at 3.22%. But due to the government's stimulus spending and other economic factors, inflation rose to a 40-year high. In an effort to slow growth without triggering a recession, or to achieve a soft landing as they put it, the Fed responded with a series of 7 rate hikes. By October 2022, the rate was at 7.08%. It dipped in early 2023, then climbed to 7.79% in October. Since then, it has bounced around from the mid-6s to the low 7s. Today's average rate is about 6.7%. There are 6 main economic factors that affect the mortgage interest rate. The first is the Federal Reserve's monetary policy. When the Fed raises or lowers the federal funds rate, mortgage interest rates tend to respond accordingly. Inflation. Rising prices erode the purchasing power of money, so lenders demand higher interest rates to offset that loss over time. Mortgage rates tend to track inflation expectations. The 10-year Treasury note yield. I'll talk about this more in a minute, but this is the closest direct benchmark for fixed-year mortgages. Supply and demand. When demand for loans is high, like during a housing boom, lenders can charge more, pushing up the rates. Economic health. Strong economic growth and low unemployment often lead to higher rates as demand for credit increases. And finally, housing market conditions. Low inventory and surging home prices can indirectly nudge rates higher. We hear about the Fed all the time, but what exactly is it? It's the Federal Reserve, the central banking system of the United States. You can think of it as the economy's thermostat, adjusting levers to keep the economy from getting too hot or too cold. Its mandate is to keep inflation around 2% and to keep unemployment low, around 4 to 5%. Its board of governors consists of 7 members, led by Chairman Jerome Powell, whose term expires in 2026. It includes 12 regional banks in cities around the U.S., with one of them located right here in Richmond. The Fed controls the rate that banks charge each other for overnight loans. Raising that rate slows borrowing and spending. Lowering the rate spurs financial activity. During each of its 8 annual meetings, the Fed determines whether or not to change the current rate. We're getting into the deeper end of the economic pool now, but this one is important to understand. The 10-year Treasury note is a debt security issued by the U.S. government to fund itself. It pays a fixed interest rate every 6 months until it matures in 10 years. The cost of these notes fluctuates. The higher the cost, the lower the yield. Investors buy these Treasury notes for safety. During uncertainty like the pandemic, demand for these Treasury notes spikes. That means prices rise and yields fall. In August 2020, during the darkest part of the pandemic, the yield sank to a historic low of 0.52%. During economic growth or inflation, investors sell their notes. Prices drop and yields rise. In 2022, when inflation averaged 8%, the yield climbed to 4.24%. The 10-year Treasury note yield is the backbone of 30-year fixed mortgage rates. Contrary to what many think, It's not the Fed's rate that directly controls the mortgage interest rate. It's the 10-year Treasury note yield. As the yield rises and falls, mortgage interest rates follow. Let me pause long enough to remind you that I am not an economics professor at VCU. I do not have my CPA or my MBA. Be sure to consult a financial professional before making any big financial decisions. And if you're thinking about buying a home in Richmond, make sure you consult a real estate professional. We can save you a lot of money and spare you a lot of misery. This is one of the big mysteries in real estate, and it happened in fall of 2024. For the first time in 4 years, the Fed lowered its federal funds rate, not just once, but 3 times, for a total of 100 basis points. Everybody in real estate was excited to see the rates come down, but instead, they went up. Why did that happen? Mortgage rates aren't directly tied to the federal funds rate. They're influenced by a mix of factors that don't always align with the Fed's actions. As I mentioned earlier, the mortgage interest rate tracks the 10-year Treasury note yield more closely than it does the federal funds rate. And that yield is determined by bond market dynamics. Despite the Fed's cuts, investors anticipated that the economy was still growing and inflation would remain high. As a result, the 10-year Treasury note yield climbed, and so did interest rates. Here's the main takeaway. Mortgage interest rates depend less on the Fed's rate cuts and more on what investors think will happen next. Enough about financial policy. Let's get very practical. What impact does the interest rate have on my ability to buy a house? For every 1% change in the interest rate, my purchasing power changes by 10%. Let's see what that means. Rates are currently right around 6.6%. If they were to go up 1%, instead of being able to afford a $400,000 home, I could only afford a $360,000 home. On the other hand, if they went down by 1%, I could now afford a $440,000 home. Do you see how that works? Think of how that affected home buyers in 2022 when interest rates climbed more than 4%. Instead of being able to afford a $400,000 home, they can now only afford a $260,000 home. No surprise that sales volume dropped dramatically. This is another frequently asked question. I'm not a financial advisor, but here are some guidelines I found helpful. Refinancing a home loan typically costs about 2 to 5% of your loan value. So if you have a $200,000 loan, you're going to pay $4,000 to $10,000 to refinance. So when does it make sense to refinance? If the interest rate drops by at least 1% and you're going to be in the house at least another 2 years. Before you refinance, check the fine print to make sure you know what the lender will charge. I know closing cost refinance may just mean that the fees get rolled into your new rate. Well, this is the $64,000 question. If I could answer this, I would be playing golf with Warren Buffett right now instead of making this video. But here's what we know. The 10-year Treasury note yield is currently high at 4.24. The Fed has chosen to pause rate cuts for the time being, though they have signaled 2 25 basis point cuts in 2025. Analysts think there's a 70 to 80% chance of this happening. What would motivate the Fed to lower its rates? Cooling inflation, currently projected to be about 2.75% for 2025, and weakening labor market if there's rising unemployment, which is currently right around 4.4%. Forecasts suggest that rates may stabilize in the 6 to 7% range for the rest of 2025. Let me end with one last question. Maybe you've heard a realtor say, marry the house, date the rate. What is that supposed to mean? Your interest rate will always fluctuate. It's like a short-term relationship. Though it has a direct effect on your monthly payment, it's not permanent. At some point, it's almost certain to go down. And when it does, you can break up with that old rate and switch to a lower one. If you find a home that you love, one that you can afford, don't be afraid to buy it. Yes, I know that 6.7 interest rates feel very high compared to the sub 3% rate you could have had a couple of years ago, but it's a lot lower than the 17% rate you would have paid in 1981. So focus on the long-term value of the home, not the short-term cost of borrowing. Marry the house, date the rate, and invite me to the wedding. Well, thanks for joining me for today's video. I'll see you on the next one.